Hey everyone, it's Tony here. So I've been reading your comments and I keep seeing the same questions over and over. Will the stock market keep going up in 2026? Are gold and silver already too expensive? Did we miss the opportunity? And here's what I need you to understand. The Federal Reserve is making money cheaper, not more expensive right now. And when they do that, asset prices tend to go up. We're talking stocks, gold, silver, real assets in general. This isn't speculation or some hot tip. This is literally how the system is designed to function. Today, I'm going to walk you through exactly how I'm thinking about investing in 2026, and more importantly, why. Because if you understand what's happening with liquidity and the Fed right now, you can make way smarter decisions with your money. Before we dive in, let me just say, I've been where you are. A few years ago, I was staring at my bank account, trying to figure out if I could even afford to invest anything. Now I've spent years researching this stuff, talking to experts, and actually putting my own money on the line. In 2025, my investments did really well because I paid attention to these exact patterns. And I want to share what I've learned with you in plain English because this isn't just for rich people. Alright, so here's what we need to talk about first. Liquidity. I'm going to break this down in plain English because this is the key to everything. Liquidity simply means how much money is available in the system and how easy it is to access. When liquidity is tight, borrowing becomes more expensive, lending slows down, and asset prices struggle. But when liquidity is plentiful, borrowing is cheap, money flows freely, and asset prices tend to rise. Think of liquidity like water in a pool. When the water level rises, everything floats higher. When the water drains out, everything sinks. Right now, the water level is rising again. So this affects anyone with money in the stock market, anyone thinking about buying gold or silver, anyone with a 401k, and, honestly, anyone trying to build wealth in 2026. Here's where people get confused. They look around and rightfully say that prices are too high. People feel stressed out financially. The economy doesn't feel strong. But here's the thing. That's not how financial markets work. What matters more is access to money. When liquidity increases, money doesn't just stand still. It seeks a return. It flows into stocks, ETFs, gold, silver, precious metals, and anything perceived as a store of value. This is why markets can keep going up, even when the economy isn't booming. As long as there's plentiful liquidity, assets rise. Okay, so let's talk about what the Federal Reserve is actually doing right now, because this is critical. The Fed controls short-term interest rates. When they raise rates, borrowing becomes more expensive. When they cut rates, borrowing becomes cheaper. And cheaper money changes behavior across the entire economy. Companies refinance debt. Investors take on more risk. Cash earns less interest, so people search for returns elsewhere. And valuations rise because future profits get discounted at lower rates. This is why rate-cutting cycles matter so much. Here's the key point for 2026. We are no longer in a tightening cycle. We're in an easing cycle, which supports higher asset prices. But there's more. The Federal Reserve has restarted balance sheet expansion. They're calling it reserve management, but let me tell you what it really is. They're printing money. They started with $40 billion per month, beginning December 12th. Now, the Fed will tell you this is technical, temporary, not quantitative easing. But the markets don't care what it's called. The markets care what it does. And what it does is inject money into the financial system. More money equals more liquidity equals higher asset prices. The chain is simple and consistent. Some people will say, oh, this money printing won't last long. They'll stop pretty soon. But here's the problem with that argument. The system requires liquidity. The U.S. government runs large deficits. Banks need reserves. Markets depend on stable funding conditions. So once the Federal Reserve opens that liquidity spigot, if they try to shut it down quickly, something else risks breaking. That's why liquidity cycles tend to last longer than people expect. Balance sheet expansion usually comes in phases, not short bursts. This isn't a one-time event. Now let's talk about what happens to the US dollar, because this affects everything you own. When interest rates fall and money supply increases, the dollar often weakens. Why? Because you get paid less interest for holding dollars, and there are more dollars in existence, which decreases the purchasing power of every dollar you have. A weaker dollar helps push up prices for U.S. stocks, gold, silver, precious metals, and commodities. For example, gold and silver are priced in dollars, so when the dollar weakens, it takes more dollars to buy the same ounce of metal. Here's something important. When the price of gold or silver goes up, the value of that gold or silver isn't actually going up. If you have 1 ounce of gold, you still have 1 ounce of gold. The price is going up because the dollar is weakening. That's all that's happening. This is one of the reasons precious metals tend to perform well during easing cycles. This isn't ideology. This is simple math. And here's something everybody knows. The current administration does not want a strong U.S. dollar. A very strong dollar hurts exports, tightens global financial conditions, increases stress on debt markets, and slows down economic activity and GDP. But a moderately weaker dollar supports growth, helps manage large debt loads, and makes financial conditions easier. Dollar weakness isn't an accident. It's a release valve. Now I want to talk about something every investor needs to understand. It's called the Fed put. If the stock market falls sharply, what do you think is going to happen? The Federal Reserve is going to step in. We've seen this repeatedly. 2008 financial crisis, 2020 pandemic, and whenever there are banking stress episodes. Why does the Fed put happen? Because a market crash doesn't just stay in the markets. It spreads to credit markets, employment, housing, consumer confidence, even government finances. The cost of not intervening becomes higher than intervening. When stress becomes severe, the Federal Reserve responds with rate cuts, liquidity injections, emergency programs, and balance sheet expansion. This is what people mean by the Fed put. It doesn't mean markets can't fall. It just means that major declines will be met with policy support. So why is the Federal Reserve trapped into supporting the markets? Because the system today is more sensitive to liquidity than ever before. Just look at the debt levels. They're higher than ever. Markets are more interconnected than ever. In that environment, financial stress spreads much faster. That means policy responses have to be faster and even larger. Here's something important that's happening relatively soon. In May 2026, there's going to be a new Federal Reserve chair. I can't tell you who it'll be, but what matters is that new leadership usually brings a shift in tone and priorities. And that shift is going to be towards easier monetary policy, definitely not tighter. They're going to want to run the economy hot, boost markets, even accept some inflation. Why? To boost economic activity and asset prices going into the midterm elections. So let's connect all the dots here. We're in a world where rates are falling, liquidity is increasing, the dollar is weakening, and the Federal Reserve stands ready to intervene if things go south. In this environment, asset prices stand to benefit. Does this mean investments will go straight up? No. You're going to see pullbacks. You're going to see volatility. But in liquidity-rich environments, dips tend to be bought. Let me share my high-level overview of what I'm doing in 2026 with my investments, given these major tailwinds that have been set in motion. I'm staying invested. I made good money in my investments in 2025, and I'm not taking money off the table to lose to inflation in 2026. I'm not waiting on the sidelines hoping for a crash in this type of setup. If there are dips, I'm buying the dips. Now, I understand the fear of buying at the top, whether you're talking about stocks or gold or silver. You might ask, how much higher can these markets go? And I'll answer with a question. How much more money can the government print? Are they going to stop anytime soon? I don't think so. And if they don't stop printing, why should the markets come down? So what should you actually do with your money in 2026? Here's my advice. First, stay invested. Don't try to time the market. In a liquidity-rich environment like this, sitting on the sidelines in cash means you're losing to inflation every single day. Second, if you're not investing yet, start now. I don't care if it's $10 a week. Open a low-cost index fund with Vanguard, Fidelity, or a robo-advisor. Set up automatic investments. Third, consider adding gold and silver to your portfolio. With the dollar weakening and liquidity increasing, precious metals are positioned well. You don't need to go all in, but having some exposure makes sense. Fourth, Keep some cash in a high-yield savings account for emergencies. Even though rates are dropping from their peaks, you can still find accounts paying 4% or more. You need that cushion. Fifth, if you see dips, don't panic. In this environment, dips are buying opportunities, not reasons to sell everything in fear. Look, I want to be real with you. We might see volatility. We might see scary headlines. Markets don't go up in straight lines. But the fundamental setup for 2026 favors asset prices. The Fed is easing, liquidity is flowing, and the system is designed to support markets. That doesn't mean there's no risk. It just means the wind is at your back. The question you need to ask yourself is, do you want to participate in this, or do you want to watch from the sidelines while your cash loses purchasing power? So remember, don't fight the Fed. They're making money cheaper, printing more of it, and standing ready to support markets if things get rough. Understanding that gives you a massive advantage. And if this video helped you understand what's really happening with the Fed and your investments, please hit that subscribe button. We put out new videos every week about real money strategies for real people. You've got this. We're figuring this out together. Thank you for the support, and I wish you a very nice day. Take care.